Today, I'm going to go over one of the key tools I use in my system when trading. It's found under forecasting and it's called the fixed range volume profile. The reason I like this so much is because, well, let's just go back to when I first started trading. I noticed myself and many other traders would use support and resistances completely wrong. We would just draw random horizontal lines and hope the price reacts. And we'd then just keep wondering why we're continuously getting chopped up or stopped out of trades. But what would you do if I could tell you I could see where market does the most business, where the real interest sits, and where price is most likely going to react? And that's exactly what the fixed range volume profile helps you do. So in this video, I'll tell you what the fixed range volume profile actually is, why many professional traders use it, and how to use it properly. So quickly, I just want to say this is different to just a normal volume indicator. This will sort of show you volume traded at price. So that distinction is extremely important. Just think about it like this. Normal volume tells you when volume happened, but the fixed range tells you where volume happened. And that's what matters most, because markets tend to remember areas where large amounts of business took place. The fixed volumes lets you manually set the range, maybe a trend, consolidation, or a swing move, and it maps out where the majority of trading occurred within that range. So in my system, that helps me identify fair value, areas of acceptance, areas of rejection, high probability support and resistances, and potential trend continuation or reversal zones. So before going ahead and using it, we do sort of need to understand just the three core concepts of it, which you'll see me mention time and time again in my trade setups or just in my general market overviews. To start with is the POC, which is the point of control. This is where price had its highest traded volume within my selected range. This is essentially the market's strongest area of agreement, and price is often attracted back to the POC because it represents fair value. It's just like a bit of a magnet. Next, we have the value area high, which marks the upper boundary where about 70% of trading activity occurred. When price trades above the value area high, the market is potentially entering overvalued territory relative to that range. And then finally, we have the value area low. The value area low is, well, it's basically just the opposite. It's the lower boundary of the value area and can act as support or a reclaim level during trends. And that's why the fixed range is so powerful and plays a massive part in my trading, because most traders, they might just look at candles, but candles alone don't tell you where participants were actually interested in trading. You know, the fixed range will reveal where buyers and sellers agreed, where they disagreed, and where the imbalance actually exists. So instead of just blindly buying support, which I used to do a lot when I first started, and it's just a really common mistake people make, you can ask yourself, is this area actually accepted by the market? Instead of chasing breakouts, you can ask, is price breaking into low volume or high volume? The distinction matters massively. So there's many ways you can actually use and set up the fixed range. It all depends on what type of trader you are. I'm more of a range trader, so this actually does help me massively. It's also good for trend continuation, but you know, I like to use it you know, where you can see price clearly consolidating. So I will use this current Bitcoin price action, and as you can see, we do have somewhat of sideways price action, or you can somewhat see price ranging. So I will normally anchor the profile around the impulsive leg. So as you can see here, here is the impulsive move, and I will get the fixed range and I'll anchor it. As you can just about see, price start to consolidate. And just by doing this on the current Bitcoin price action, you can already see how well respected the value area is. You can see the value area high as resistance here. You can see the point of control. As soon as price falls under it, it's acting as resistance again. But price breaks above, retest the POC, and then we go for a breakout deviation above, which is a failed auction, above the value area high, and then back inside the value area, before eventually rejecting the point of control again and coming back down to the value area lows, again where we deviated below it, reclaimed after a number of retests, and now we have had that impulsive move back towards the upside, where again, price has retested the value area high, acting as resistance, and now it looks like we're going for a breakout here, closed above, and we have a retest of the value area high there. So what I'd want to look for next for potential continuation, if this breakout is confirmed, I'd want to look for acceptance above the value area high, a higher value formation, and retest of the point of control, and then continuation. So if price can do something like this, come back down to the POC, and then start gaining that acceptance, to me, that is a very big continuation, confluence, and a long trigger. Because else we end up just getting a failed auction where buyers lose control and sellers step in, and all we do is simply deviate above the value area highs before falling back inside of it. And that's just another extremely powerful concept of it, because if price does push above the value area high, but fails to find that acceptance, just like that example I gave you, and quickly rotates back inside the value area, again, that's like I said, that's what you call a failed auction. The market attempted higher prices and rejected them. This can create strong reversal opportunities, and the same logic applies to the value area lows. So that back inside here on the lower time frame would have been the perfect short trigger, at least back down to these lows. And again, the same happened here, deviated below the value area. Buyers stepped in, sellers became exhausted, and we came back up to the point of control before going for another break below the value area. And again, buyers stepped back in. So if the same thing is going to happen again, we are going to get a failed auction. Would you just short that again? And the answer is possibly yes, but if you can get other confluences, then that will certainly go in your favor. Another one I like to use, which you will know, is EMAs, specifically the 12 and 21 EMA. So if price does repeat this price action here, the sellers become in control and we get acceptance back inside the value area, to me, if we are to fall back under the point of control and these 12 and 21 EMAs, that would be the perfect short trigger back down to the value area lows. And obviously looking at it from this value area range is because there's about a $2,000 difference. And that's because this is set up on the H4. If you're going to want to look for more greater swings, again, which I do post, you can possibly look at the daily, look for price action to present, you know, something similar to this, some consolidation. And then you can set up the value area like that on the daily where, you know, where the ranges are going to be a lot wider. And again, you're going to want to implement other confluences into that as well, EMAs, moving averages, and there you get your perfect swing. Something like this could be potentially an intraday trade because, like I said, there's only a $2,000 difference. You know, maybe you hold it for a few days to a week. Like I say, it all depends on the time frame you're using it on. For this example, it is on the H4, so it's slightly lower time frame. So I'll just show you a quick example. If we go back to the daily, we zoom out, we can quite clearly see this impulsive move here. So we will get a fixed range, place it after the impulsive move. And here we have a value area range located on the daily, so slightly higher time frame. So if price is to find its way back here under 72.7k, acceptance back inside the value area, then you could, then you could look at the point of control here on the slightly higher time frame around 66.8k. And this is how I get a lot of my higher time frame targets. The value area low here, as you can see, it is a very respected support, as you can see here. So on the higher time frame, if we come back under that H4 value area low, back under the daily 12 and 21 EMA, we can possibly look for a bounce here at the value area highs. Or again, if price finds acceptance back into it, that is the perfect short trigger in my opinion to trade it to potentially the value area lows. So to slowly start ending this video, the fixed range is quite clearly a powerful tool, but you shouldn't be using it alone. You can use it if it aligns with current market structure, liquidity, trends, EMAs, and higher time frame levels. And just because price taps a level, that doesn't mean it's valid. Acceptance is what matters, and that is what I'm very vocal about in a lot of my tweets, in a lot of my posts on Telegram. It's just not about that singular candle closure, it's about acceptance. So you need to know and how Well, you need to watch how price behaves around the value. Is it accepting? Is it rejecting? Is it building value? Or is it quickly rotating away? So depending on your strategy and how you anchor the fixed range, you can now immediately identify the POC, the value area itself, thin liquidity zones, and areas where price has moved inefficiently. So if price retraces into the POC and finds support while maintaining higher time frame structure, that becomes a potential continuation long, like I just previously explained. But if price loses the POC and starts accepting back inside the value area and even added confluence under key EMAs, that could suggest the breakout is weakening. So all of that together is why, in my opinion, the fixed range volume profile is one of the best tools for understanding market acceptance and positioning. But remember, the indicator itself is not an edge. The edge comes from understanding the concepts, acceptance, and how auctions move between values. So if you did enjoy that, just let me know, and I will potentially do other videos like this where I cover other good tools and confluences to use to gain those high probability, high RR setups.